Hello, everyone. Hope you guys had a wonderful, amazing weekend. Happy Sunday. This week is going to be pretty interesting. So we're going to take a look at what the next steps are for the market. Obviously, the market is showing a lot of bearish signs. Everyone is looking at that 420 level on the SPY. We're going to take a look at everything together. All right. We're going to take a look at the yields. We're going to take a look at the bonds, the VIX, the dollar, the large tech stocks. And obviously, of course, we're going to take a look at the S&P, the NASDAQ, and the Russell. All right, so without further ado, let's get started with the video. All right, first things first, let's take a look at the weekly news. So Thursday, we have GDP numbers coming out, pre-market. And then after market, Fed Powell is going to be speaking. Then Tuesday and Thursday, we have some important news like during the market. So that's going to be important. So Tuesday, Thursday, and Friday, we have important news during market hours. So we cannot be in positions during those times. Holding on to any position at 10 a.m. on Tuesday, complete gamble. All right, so just keep that in mind. Swinging anything into from Wednesday into Thursday morning is going to be risky because of the GDP numbers coming out Thursday morning. All right. And then the same applies with swinging anything from Thursday to Friday because Fed Powell speaks. So yeah, there's a lack of setups for swinging this week. All right, so there's that. Now let's go ahead and take a look at the charts. All right, so the first thing that I want to look at are the yields, and the yields are relevant to the overall stock market because when the yields are higher, equity prices fall. So immediately right now, we see that the yields all broke above their most recent resistance levels and highs. So we have the 2-year yield coming back and retesting the breakout point. And what I want to look at is other different yields. So the 5-year yield has not yet came to this breakout point. We have the 10-year yield also has not yet came to the breakout point. And then let's take a look at the 30 yield. That has not come back to the breakout point either. So my point of showing this is the larger yields, obviously not the shorter term 2-year yield, but the 5, the 10, and the 30 all have space to come back and retest the breakout point. And if that is the case, right, and if the yields end up falling lower, then that should be a good sign for stocks to bounce in the short term. So that's not like an immediate automatic reason to be bullish on the stock market, but this is showing that eventually, even next week, right, we could end up going higher, but this is like we should be getting a retest here. It might not happen immediately, but there's a good possibility that we should. And one of the issues that we have with basically getting that quickly is that we are back within the Bollinger Bands. So if we had closed outside of the upper Bollinger Bands as well on the 30 yield or the 10, right? If we were more overextended to the upside and closed outside of the upper level of the Bollinger Bands, there would be a higher likelihood of us falling. But since we are back within the Bollinger Bands, we are no longer technically, algorithmically overextended to the upside. This means that we still technically could hold this as support and then just bounce. And of course, we know that if it bounces, then it's bearish for the market. All right, but this is, we're starting to show some weakness on the yields, and we should get a retest of these breakout points on the larger yields. The 5, the 10, and the 30. So there's that for the yields. Next, we should take a look at the bonds. All right, so the bonds are obviously also, the bonds are important to show because this is more correlated to the market as well sometimes. So this generally has a bigger correlation when we break below important levels of support or when we reclaim important levels of resistance. So the bonds are correlated to the market. If the bonds are doing well, then the overall market would also be doing well. So and it works best when we're at extremes. So we're currently at an extreme, right? We opened outside of the bands, and this strength, if we get a clear break back above 117.30, 117.25, this should get us, we should see this strength permeate in the overall market. And that is going to be interesting to watch. The next thing I want to show you guys is the TIP. So the TIP ETF also ended up making new lows. But one of the scary things here is when you overlay the chart of the TIP with the NASDAQ, you basically see that the TIP and the NASDAQ have historically like moved in the same general direction. So if the TIPs were bearish and the bonds, if the TIP ETF basically were bearish, then the NASDAQ would also be bearish. And this is where the bonds and like this is where the main correlation occurs with the market. When the bonds are showing strength, that really shows the most in the tech sector. But what's interesting, right? So obviously you could see, the NASDAQ very weak. Also, this orange line, the bonds also very weak. Cool, right? Correlated. But when you like recently, right? So as we've bounced off of the lows on the NASDAQ, we've also bounced off of the lows on the TIP. But now what's most interesting is during this downturn from March and April, the NASDAQ has been falling. The TIP has been falling, right? But the NASDAQ has been rising. So obviously during this video, I might have like misspoke and said that this chart is the NASDAQ. This chart is obviously the TIP, and this orange line is the NASDAQ. All right. So what I want to show you guys, basically just the destructive potential in the market is now that we've saw the NASDAQ really rising and bottoming out, rising here, the correlation has not occurred since this time, especially as the NASDAQ has been rising in March and March and April, sorry. So as the TIP, let's check this out. Basically, as the TIP ETF has been falling, that should have been causing the NASDAQ to also fall. But instead, the NASDAQ skyrocketed. So now this is bad because the NASDAQ is starting to try to catch up to the weakness in the bonds, potentially. And if that occurs, then the NASDAQ is going to fall very dramatically. And because it has to generally be correlated, right? So if this catches up essentially to what the bonds are doing, then this is going to be devastating for tech stocks. And because we're already seeing this weakness out of the bonds, but it was just abnormal equity buying pressure out of the tech stocks. But now if things come back to normal, then this NASDAQ is really going to cause the TIP is really going to cause the NASDAQ to fall pretty dramatically. All right, so I hope that made sense. All right, next, this is a daily chart of the S&P 500, and I want to show you guys some interesting things here. All right, so obviously I don't have any indicators or anything on the chart, and I want to show you guys a level of support from back in October. So this is a very important support level from October down here from March, right? And if we just connect that, we are getting very close to that level here. And it could potentially just be maybe a week or two away. And this level would basically be around the mid 420s. So this is a really important support level on the SPY. And when you look at the 200, you look at the different moving averages as well, right? So we know that the 420 level is a very important level of support. So the JP Morgan Collar trade as well for this month, it has a lot of put gamma at 420. So as the price gets closer and falls lower, there's a higher likelihood that 420 is going to continue to be a magnet for that price. and basically it coincides pretty well with the 200 simple moving average, as well as like prior very, very important levels of support. So this support level I have is historically very, very important at 421. That's where coincidentally JP Morgan's collar is also priced at. So yeah, so immediately, guys, this is not looking bullish. So obviously we broke below the most recent lows here from August 18th, right? And you'll see just a similar situation on the NASDAQ, as well as you'll definitely see a very similar situation on the NASDAQ in terms of the trend line. But the NASDAQ actually broke the trend line. But overall, the 200 simple moving average is going to be a very, very important level of support moving forward. And especially, so the collar expires, JP Morgan's collar trade expires this Friday. So by this Friday, we could even see 420 on the SPY. So let's see if that plays out. But regardless, we have some things to look at on the short term. Okay. So on the immediate short term here on the SPY, obviously this is still very, very weak, right? But what is the SPY currently doing? We have completely broken outside of the lower level of the Bollinger Bands, and we have opened and closed outside of the bands. So what I usually say, and what I always say, is when we open outside the bands, there's a almost guaranteed likelihood that we retest the lower level of the band. So if we opened outside the low, we get a retest to at least the lower line of the band. And that's what happened. We ended up opening outside the low and bouncing within, and then ended up falling lower. So that's great. But what this is showing is that things are very, very overextended to the downside. Algorithmically, things are very, very overextended to the downside. Okay. And with the yields also being overextended to the upside, this is not the time to pile into shorts. What makes more sense is giving a bit more of a bounce. Obviously, we might not even get that bounce, guys, but we cannot start swinging short aggressively. That's my point. What we would rather see from price action standpoint is once again, a nice little gap down. What I was saying on Thursday, remember Thursday's video, I was saying, I hope we get a gap down. What we don't want to see is a gap up, because they're just going to bounce it a bit and then make it fall lower. What we want to see for a bullish potential move is we want this to gap down lower. If this gaps down lower, we can easily, it needs to be like a substantial little gap down, right? But if this gaps down to maybe even 428, 428.50, it will be much, much easier to have a bias for the day, and we could just end up being bullish, because that would just be very, very overextended to the downside. Things are aligning for a bit of a small bounce, but heading into the end of the week, 420 is going to be very important. And then to the upside, I believe the level was 437. I could be wrong. I'm not sure. But I know for a fact the 420 level is very, very important. And that's where the put gamma is. But yeah, so immediately, right, for a break to the upside, if we do end up breaking above 438, 437, then we can continue going up higher. For like a little retest of these levels here for an eventual back down. But yeah, it's tough to just be blindingly bearish here. The yields and the rates are showing overextensions to the upside. The bonds are showing overextensions to the downside. The equity markets are showing overextensions to the downside. Can't be bearish here. You cannot be extremely bearish here. And guys, we have not even looked at the VIX. And the VIX is very important, obviously, because it has a more inverted relationship to the market. So if the VIX is showing strength, then the market is going to be showing weakness, right? But what we're seeing right now is the VIX having clear resistance at the 200 simple moving average. And it is very overextended to the upside, according to the Bollinger Bands. What this is showing us is that there usually should be a retracement and eventually a close inside the Bollinger Bands. When we show weakness on the VIX, which is what I'm assuming will end up happening soon, when there's weakness on the VIX and we get a close within the Bollinger Bands from up here, if we fall on the VIX, that's going to be bullish for the stock market. Okay? And just like simply though, we have seen in the past the VIX was comfortably trading outside of the upper bands. That's not out of the norm for the VIX. 100% it could easily continue doing that. But when it does that, that's the time to start looking for the opposite side of the trade. All right. And another thing that I just magnifies that concept is Tesla. So Tesla, big drop. Big drop. When Tesla makes these big, disgusting moves to the downside, you don't start to lean bearish. You start to look for good buying opportunities for a bounce. Time and time again, we've seen when Tesla shows a really big green candle, for example, that's the wrong time to go long. If we see a big red candle, for example, that is the wrong time to start going short. It is a much better time to start looking for buying opportunities. So, yeah, essentially, Tesla is starting to show some clear-cut weakness. If we get another big move to the downside, then Tesla is going to be very overextended to the downside, because you can see that the Bollinger Band on Tesla is just, the lower Bollinger Band is just pointed straight up. So when it's pointed straight up like this, there isn't that much more room to fall before Tesla becomes algorithmically overextended to the downside. So that's important to take into consideration. When you take a look at Apple, Apple is just holding above this 173 level and trying to hold on to the 175 level for dear life. Amazon is getting close to being overextended to the downside as well. It's definitely not, there's still more room to fall on Amazon for sure, but it's getting there. Google, similar situation to Tesla's Bollinger Band. Google's Bollinger Band is pointed up. So one more bad move on Google can get it overextended to the downside for a potential bounce as well. Netflix is starting to actually Netflix is might be a good buy soon, to be honest. And Netflix, if we get a big strong move out of Netflix, this is hurting me to say this honestly, but Netflix is starting to get really close to this 200. Honestly, if this was like another stock, we would start having to get some longs, to be honest. It's kind of unfortunate, but Netflix is starting to look pretty interesting. Especially, guys, the reason for this is you just cannot, man, you cannot be bearish on a stock when it's falling like this. Like, damn, freaking Netflix, man. Unfortunate, but Netflix is really starting to. Yeah, if we get another drop on Netflix, even down to 370 on Netflix, is probably going to be a really good buying opportunity. All of this is honestly pretty solid buy opportunities. Get some like leaps for 400. That, damn, Netflix is starting to look pretty good, to be honest. We looked at Amazon, Apple, Microsoft. Look at Microsoft. So it closed outside the lower band. We have more room to fall on Microsoft. Looked at Amazon, Google, Apple, Facebook. Facebook is still holding its own, really. But my point is that Google and Amazon, Microsoft have maybe another day or two of potential falling. Netflix is starting to look like a good bottom. Apple is holding support and Meta is holding support. So it's going to be pretty interesting. Now let's take a look at the chips. So the chips are very relevant, obviously. So this is a chart of Nvidia. We held this uptrend level. I don't know how much longer we're going to hold it. But this uptrend level from back in December, this has been acting as resistance, then support, lots of support in here, and now we're basically back to that level. So yeah, Nvidia is holding support. This still can have another big move to the downside. This is not really the time to start going long Nvidia, unfortunately. This was a very disgusting, just small baby weak move on Nvidia. Not what we want to see. What we would have rathered see is a nice like green candle, nice strong green candle. Even if this candle was here, this would be much more bullish. But this is not the sort of indecision that you want to see at a trendline support, especially with bearish momentum, where we could easily have another leg down. Especially since the Bollinger Bands are also pointed lower, we could have another huge leg down, and it'll still just be within the algorithmic move to the downside. It won't be overextended, so that would be bad. But when you take a look at AMD, AMD is much more overextended to the downside, and it is right at the 200 simple moving average. So if we did get another move to the downside with Nvidia and AMD, this would be a much better opportunity to buy the dip, because then it would just be very overextended. It would be much more overextended to the downside and give it a much better buying opportunity, in my opinion. And when you take a look at the ETF, SMH ETF, this is still showing some weakness, very similar to Nvidia. And then when you take a look at TSM is at a very important support level here at 85, but also looks very similar. So the chips have another potentially one day to go to the downside. Hopefully we could just have that sell off tomorrow into the open. Honestly, hopefully in the open, the chips sell off, the tech stocks sell off, the SPY, the NASDAQ, all of them just open a bit lower, and it would be a much easier opportunity to just buy that dip for Monday and just trade it for Monday to the upside. That's what I would love, actually. It's what I would absolutely love. But, you know, we don't always get what we want every single day, but hopefully that is the case. And yeah, you know, we just have to continue monitoring what the market is doing day to day. The tech stocks are the key main drivers so far of obviously what was happening. So yeah, I'm just very interested to see what the tech stocks do. And I hope you guys enjoyed today's video. We're also holding on to IWM calls. So this is a very key 176, 175.50 support on the IWM. Coincides pretty much with if everything has another down day, we could, because this is already pretty overextended to the downside, but it's not, we haven't opened and closed outside. We just keep on closing outside. So, you know, this is still shows more room to the downside. And if that happens, then we could get a nice spring to the upside. But until then, I don't want to go long again or swing long until we potentially get a move to the downside closer to 428, 429. That's when I would much rather try to catch a bottom on the SPY, and then we can get a move to the upside. So yeah, that's what I'll be looking for this week. Hopefully it happens Monday, because the longer it takes for us to drop, the higher likelihood that we're going to continue dropping. If on Monday we get a big gap down, then there's a very low chance that we'll continue falling. If we get a gap down on Monday, there's a high likelihood that we get a bounce. And from that bounce, we could potentially get like a bit of a bottom and a move back up to maybe even 435. The craziest thing would be if we fill this gap down here to 438.43, but I don't know if that'll happen, but bulls definitely want this to gap down. All right, so I hope you guys enjoyed. Hope you guys have a wonderful rest of your Sunday as well. And yeah, man, I hope I did a good job explaining the yields and the rates and the correlation between that. So yeah, man, I hope you guys enjoy, and I will see you guys bright and early tomorrow morning. Thank you guys so much. Take care. Love you guys.